Let's bring in CNBC senior economics reporter Steve Liesman, knows all about that. Ahead of the Fed, Steve, and of course the Fed is looking at a lot of the same issues and influences that we're trying to hash out and perhaps doesn't have a clear answer of how it might proceed.
Yeah, I'm not sure it has any more insight than anybody around that table there, maybe even less. I think there's three forms of communications that happen today. There's the statement, there's the forecast, and there is the press conference. And I think the surge in the price of oil will have an effect on all three. It's likely that you're going to get some commentary in the statement about geopolitical uncertainty, as well as some change in the forecast. And what we're looking for here, Mike, is the extent to which the dots signal one or possibly no cuts in 2026. You can see what's happened to the probabilities. They cratered this morning, in part after that hotter than expected wholesale price report, in addition to oil ticking up closer to the 99 level than it was this morning, around $94. And Mike, I like your framing of this 4-week window, which we talked yesterday to John Kilduff, and he talked about this idea that if this strait is not open by April 1, there's another level or another leg up that's going to happen to oil prices that will be much more meaningful than it's been so far.
Hey, Steve, it's Joe. Good to see you. So the market has been troubled so far in 2026 by much more than obviously the challenges related to the Mideast conflict. And one of those trouble spots has been software and private credit. Any chance I get some comfort in this press conference where the chairman can convey to us that he is at least communicating with Wall Street lenders, and they are on top of gaining an understanding of what the real valuation of these private loans actually might be to the software industry?
I was with you all the way to the end. I don't think the Fed goes quite that far. Joe, I think you have to appreciate that the interests of the Fed and the interests of investors are somewhat different here. The Fed wants to know if what's happening in private credit, and especially with software, is something that's going to infect the money center banks for which they're in charge, and create systemic risk that will prompt them or force them to have some kind of reaction, either in the markets or in policy. And I think what they're generally have said about this is investors in private credit are free to lose as much money as they possibly want or make as much money as they possibly want. What they're not going to be free to do is to create some sort of big reaction in the banking system. And what I think he'll say, and what he has said before, is that they're looking at this and looking at the connections to the banking system. But I don't think you're going to get any sense about whether or not what the valuations are, whether or not the marks are right, which is the big question for investors right now.
All right, so I'll correct my statement there, and 100% I agree with how you eloquently explained that. But at least can we get a degree of comfort that the communication channels are open and they understand right now that there are questions surrounding a lot of these Wall Street lenders, and maybe a degree of clarity is needed?
I think that's something that is definitely something that the Fed chair has said and will say again, that it's something they're looking at. It's on their radar screen. I think there was a lesson they learned from SVB, which is don't let those sort of things go unnoticed and take them very seriously when they happen. And I think also, Joe, coming from the great financial crisis, it's something that they're very aware of, this idea that there can be things that look like they're remote from the banking system, but end up being connected in ways they haven't figured out before. I think one of the questions you have is, well, what are the letters of credit of some of these private credit vehicles to the banks? And if they hit a liquidity crunch, can they draw on those lines of credit? And does that all of a sudden create this kind of danger inside the banking system from private credit?
Yeah, one of many topics we're going to have to cycle through in that press conference. Steve, you'll be there. You got to get going. I appreciate it this morning. Jim, everybody can kind of seize on their favorite example from history of how monetary policy interacts with a high oil price or some kind of an energy shock and the inflationary threat. So the 70s, everyone knows, didn't get control of it. There was easing into this shock. But you go to 1990, I've seen a lot of work there. The Fed was slow to ease, even though jobs were weakening, and we got the oil price shock in the first Iraq War, in part because of the inflationary threat. 08, Fed went on hold for 6 months after, Bear Stearns, right? And so 2011, the ECB hikes into it, and that was a mistake. And then, of course, 22, you didn't want to let it go. And the Fed didn't get ahead of it when commodity and other prices started going up. So maybe that's not really a roadmap. So what do we want from the Fed today?
Yeah. Well, how about if I answer the corollary of what do we not want?
Yeah, sure.
I don't want to hear any more talk about rate hikes. We had some talk about that at the last meeting.
Agreed.
Now, okay, I know this is a very small probability of rate hikes this year, but the problem for me intellectually is I can't take it off the table, Mike. So when you were setting up that question, I was thinking, man, he's reading my mind. It would be, in my opinion, a policy mistake to raise rates in response to an oil price shock. But the problem is we can't rule it out because we do have some hawks on the committee. And also, you know, look at PPI today and look at other inflation indicators. Yeah. We don't have inflation under control, and we've kind of got a hot economy. So, I mean, that's what's kind of keeping me up at night. Is there a possibility that we not only back out the rate cuts? Let me just put it to you this way. You know, at the beginning of 2022, late 2021, we were still talking about, we're not even thinking about, whatever the expression was, rate hikes. And then we were.
It's true, although, Bryn, we came into this phase, you know, before the Iran situation flared up, with the Fed already kind of on hold. Both the jobs situation as well as inflation were not quite at their target, but they also weren't emergencies to respond to. So I wonder if the market's okay with the idea we're going to be data dependent, we're going to get a new chair. Right, there's going to be a different orientation, and so maybe at least we can get some comfort for a few months that, if nothing else, hikes are not in the offing.
I think having a new chair is a game changer, and so I think that we will get rate cuts. It's not if, it's when. I think that if you look at the inflation that we have, the inflation is not demand driven, and so I think when you think, what tools does the Fed have to actually reduce inflation? Does raising rates do anything for housing? Does raising rates do anything for home health care because of the lack of immigration? Does raising rates do anything for food? No. And so I think the Fed's toolbox in terms of raising rates would have a counter effect to it. And if anything, I think they're going to focus on jobs, focus on the uncertainty. And that's where I do think later on the year, when worse comes in, we will get rate cuts. But I do think it's important to understand this inflation is not demand driven. And so we're not having all these loans being created and the Fed can raise rates and then all of a sudden lower that demand. And so I think their really hands are tied. And so I agree with Jim. I don't think it makes any sense for them to talk about raising rates in this environment, because I think it would have the negative impact of whoever would vote for that.
I agree with both Bryn and Jim. I'll take it one step further. I actually think they should be cutting rates in this environment. I think sustained oil prices have a deflationary effect. I cited yesterday the period between 11 and 13. If we could show the chart of oil, if we have it, during that period, we had the average price of oil above $90 for that 3-year period. What helped in that environment? You said yesterday valuations were cheap. Sure. Totally correct. But also, we had QE in effect. Well, right. We had a very low and easy interest rate policy, and that acted to offset that effect on consumers from sustained rising oil prices. And I really think sooner rather than later, if you tell me we're going to average $90 a barrel and you're going to go to the gas pump and it's going to be $3.65, you're going to need another rate cut.
Well, I mean, I would argue, too, though, you were coming out of the biggest deflationary credit shock in memory at that point, and you had underlying inflation that was way short of the target, not above the target. So, we can say it's analogous on some level. Certainly, that's a nominal price chart right there in terms of WTI crude. In real terms, it's way lower right now, and in theory should be less of a drag on growth. But I just think it's going to be interesting to see how how Powell and the committee frames it, how it all translates into, the dot plot. I still think that they're coming from a place of thinking rates are above neutral. Right. And therefore, you're looking for the opportunity to get them down toward neutral. But, we'll see if that thinking has been revised.